Okay, good afternoon. Welcome to The Flip Side with Eric Jorgensen at Main Street Financial. Today as my guest, I have Michael Orleans from the Meltzer Group. He has a certification in long-term care, and today our discussion will be about long-term care insurance, what it is, what it's not, and what people need to consider before they purchase. As always, this is going to be focused primarily on families with special needs, that is our target demographic, although much of what we talk about will affect those without special needs. Michael, would you mind giving us just a brief overview of your background and your experience?
Of course. Yes, I've been in the insurance industry for about 15 years, as selling life insurance, disability products, and long-term care insurance. I received my certification in long-term care insurance about 5-7 years ago. I've been with the Meltzer Group for 10 years.
Awesome. Mm-hmm. So let's just get started by explaining what long-term care is. Can you give us an overview what long-term care insurance is and what long-term care is?
Sure. So the need for long-term care insurance is dependent upon a variety of factors. The inability to do 2 out of 6 activities of daily living, as they're called. Some examples of activities of daily living would be eating, bathing, dressing, transferring, using the bathroom. Any trouble with 2 out of these activities of daily living can result in the qualification of long-term care insurance. So that's one qualification. Another qualification could be a cognitive impairment. Cognitive impairment, Parkinson's disease is one cognitive impairment. Alzheimer's disease is another cognitive impairment. That would also be an automatic qualification for long-term care. So that's how you qualify for long-term care. But long-term care is a product where it can be used in the home, an adult daycare center, assisted living facility, a nursing home. So depending on where you need the care or what type of care you need is where the long-term care would be delivered.
Okay, so it's not, as some people may believe, strictly nursing homes.
No, it's definitely not strictly nursing homes.
Okay. And what are the odds? I mean, as our population, we're aging, we're living longer, what are the odds that an individual is going to need long-term care?
Well, according to the U.S. Department of Health and Human Services, 70% of 65-year-olds and older will need some sort of long-term care insurance. They'll need some sort of care, whether it be in the home or a nursing home.
Wow. So yeah. 70% will need some type of care. And then you look at how many families are already taking care of an individual with a special need or disability. That's something that those families, it's possibly another cost, right? Another concern.
Yes, family members, it's a lot of people focus on the cost of long-term care insurance, and it is a tremendous cost for home care services as well. But I think another cost that often gets overlooked is the burden to the other family members. And a lot of times when I meet with clients, they may have the means to pay for long-term care and they want to do it, but there's other reasons. They don't want to burden their children. They don't want to burden their family members. And I find it's an emotional connection as well. So individuals who purchase long-term care insurance, it's sort of a 1 degree removed from separation, knowing that they saw a parent that went through long-term care insurance, and they were so happy that they had the coverage. Or maybe they saw somebody who needed the care and they didn't have the insurance and saw the trickle-down effect on the family. So again, long-term care, it makes financial sense, but it's also an emotional purchase in that they really don't want to burden anyone else.
Okay. And are people limited to just buying a standalone long-term policy, or is there other options out there that people can maybe do other options to self-fund some of it and then something else?
Mhm. Yeah, it's an interesting conversation I have with my clients, and just in the past 10 years, I've really seen the industry really sort of reinvent itself as well. Um, some carriers jumped the gun and dove right in, and I think they're paying the price for it. And other carriers have been in it for the long haul. And as a broker, I'm carrier agnostic. I just care what's best for my client. So you have Genworth as a big player. You have the John Hancock as a really big player. And, they've, some of my clients have been concerned about rate increases. And I'll tell them, the initial shock of a rate increase is nothing that anyone wants to receive, but it's actually a really good thing because the market is correcting itself. And while the carriers are giving the rate increases, they're also stabilizing their book of business. So hopefully it'll become less and less. But back to your question, I'm sorry for the tangent, but back to the question about different options. There are many different options than the traditional long-term care insurance. I don't know how palatable they are, but I've had clients that have gotten a reverse mortgage. Once you're over 62, that's a way of funding the need for long-term care. There are various hybrid products that have come out. And there are pros and cons to some of these hybrid products. While they'll insulate you from a rate increase, most often the devil's in the details. So what I mean by that is they're not comprehensive products in that they may not pay for home care. Most often these products, they do not offer inflation protection. So it's a pro and con list. They work for some, but if you really want a true long-term care contract, you need to buy a comprehensive, standalone long-term care policy.
And if you're not sure what you need, the best option would be to talk to a planner, talk to a broker, and get a really somebody that can ask you the hard questions, right? I mean, rather than try to go online and get it from who knows what.
Right. In the world of insurance, there are brokers and there are agents, and the brokers are generally carrier agnostic. They don't care what they sell, as they do what's best for the client. You have agents, on the other hand, who will likely steer clients to the company that they represent. It may be the right company. It may not be the right company. But impartial advice is always best. I'm always in favor of going the broker route. Obviously, I am a broker, so I guess I am a little bit biased.
Well, I'm a fee only planner, so I'm right there with you about the.
You definitely get that as
well. So you mentioned that some of the hybrids may not pay for home health care. They typically don't have inflation protection. Why is inflation protection important? I mean, what does that really mean?
Inflation protection buys you future cost of care. So I'll disclose this. I'm 47 years old. And let's say I buy a $5,000 a month daily benefit, okay? And 30 years from now, when I'm 77, I start needing that long-term care. $5,000 is probably not gonna help me out a whole lot because it's not keeping up with cost of inflation. But if I have 5% compound inflation, now I have $20,000 a month of coverage instead of having $5,000 without the inflation protection. So it's very, very important when looking at a policy to have inflation protection.
Awesome. So the last thing I just want to circle back around on, you and I are both parents of an individual on the spectrum, and it's something we both think about, not to put words in your mouth, but just from our past discussions, is what's going to happen, should we need to care? It's not enough to say, because it's not enough to say, well, we'll just use our assets to pay for the care, right? Because that may not be the right answer. It may be a better answer to say we get one of those hybrid products you were talking about, and perhaps take half of the policy or half the annuity or whatever and use that. So would you mind explaining in a little more detail what a hybrid is and how that would work?
Sure. I've seen hybrids work best with a single pay product. So it could be, let's say, a single pay universal life policy, where think of the phrase live, quit, or die. So you put $100,000 into a product, and you live, and you need the care. Okay, so that $100,000 will buy you, let's say, $6,000 a month. And this all depends on underwriting and age, but I'm just throwing out numbers. $6,000 a month for 5 years. So that's great. I have the care. If I need long-term care insurance, I have it. So the negative of that might be, well, there's no inflation protection on that product. Another negative would be, well, it's not a qualified, comprehensive long-term care policy. It might lack home care. But that might be okay for some people because they just want to sort of hedge their bets. And I mentioned live, quit, or die. So that was the live product. The quit product is maybe 5 years down the road, they decide, you know what, I really don't want this anymore. So instead of forfeiting the policy, they get all their money back. Put in 100,000, they get 100,000 back. They get to the point where they die, let's say 15 or 20 years, they still wanted the long-term care insurance, they just never needed it. Well, there's a death benefit associated to it. It's not a large death benefit, but it's something. The point is the client did not take a loss. And I think that's sort of a positive about a product like that over a traditional long-term care insurance, because if I buy a traditional long-term care insurance and 5 years down the road, I say, you know what, I don't want it. Well, I've lost the premiums I've put into it. If I die, well, you've lost the premiums that you've also put into it. But if you needed it, and this is the big takeaway about being really all in for long-term care insurance, is that you've had a comprehensive standalone long-term care insurance policy with inflation protection at basically a fraction of the cost of the $100,000 policy.
Because correct me if I'm wrong, traditionally, it's not people jump right into the nursing home. Traditionally, it gets worse over time, right? You might start off with a home health aide and then move into an assisted living. You may never need a nursing home. But if you need the home health aide, if you need assisted living, that standalone long-term care policy would pay for both of those, correct?
Yeah, I've seen a lot of numbers in long-term care. When clients ask me about cost of long-term care insurance, I say it really depends on two things: where you live, and also what type of care are you going to be needing. So, a home care it's probably in the range of $3,500 a month. Assisted living facility is probably in the range of $5,000. And a nursing home is really the most expensive form of care. That could be closer to $6,000 a month. I've seen it close to $100,000 a year. So that would be, over $8,000.
You're talking about the memory care, the additional care that goes on top of, that Alzheimer's patients would need versus somebody with just old age concerns.
Exactly. And that the average time somebody needs long-term care insurance, while it's surprisingly low. It's about 2.93 years. But you get an Alzheimer's patient, that claim can go on for very, very long. Home care, it depends on the type of care. The home care, about $4,000 a month. It could just be homemaker services, helping prepare with meals. It could be skilled nursing care, someone to, give an IV, and that can be done in the home as well. There are certain carriers that will actually pay for a family member to give a home care.
And this doesn't necessarily mean elderly, right? This could be somebody middle-aged that needs long-term care.
Exactly. And, the long-term care companies, they want to have care delivered in the home. Okay. So, and they give discounts for married couples. Same sex, doesn't matter. Any married couples, they give big discounts for. They'll also pay for home modifications, usually one time your monthly benefit. So if you have a $6,000 a month benefit, they'll give you $6,000 to pay for modifications, maybe a railing put in or some ramps. Nursing home care is very, very expensive. Like I said, could be upwards of $100,000 a year. So it's in their best interest to keep you at home and happy at home as well, too. So if they have to throw in some extra money to make sure that you're happy, they'll definitely do that. If it's a family member that's giving you care and you want them paid, some carriers will allow that as well. Some carriers have a cash benefit as well. So these contracts, I should have mentioned this, are usually reimbursement contracts. So you get the care, you get a bill, you send the bill in. But other carriers will be like, look, you're on long-term care, here's cash. And they'll give a percentage of your home care benefit in cash so you can handle it.
And thank you for mentioning that, because a lot of my clients are telling me they want to be taken care of at home. They never want to go to a nursing home. And then I feel like it may be more difficult, especially if you're self-funding, if you're trying to pay out of your investments, to really deliver all the care you need in your home. Whereas with the long-term care insurance, you're getting that money right back. It's not as painful.
It's nowhere close as that painful. Yeah, it's a reimbursement contract where you get your money back. If you're self-insuring, not only are you not getting money back, but you're losing investment returns, and your money is ceasing to grow.
Right.
And it's less for your future, it's less for your retirement, it's less for if you want to leave a legacy, it's less to go into a special needs trust for your child. So these are very important facts when considering whether to self-fund or purchase a long-term care policy.
So last question for you. What age should people really start considering whether or not to purchase a long-term care policy? And if they do, when should they really be looking at, I want to get a policy?
Okay, so I can't just answer it simply. I have to make things simple. So I'm going to answer it two ways. So generally, it's in your mid-50s is when a bulk of my sales come into. That's when clients really need to take a look at it and purchase a long-term care. The second part of my answer, actually I could add like 3 or 4, but I'll stop at 2. The second part is remember when I mentioned that long-term care insurance is an emotional purchase? They've seen a parent go through it and it really touched them and they want to make sure that they're taken care of. Well, those clients, some of them are in their 30s, some of them are in their 40s. And what's great about doing it at a younger age is you're locking in your insurability, because these clients that are in their 30s, they might not qualify in their 50s or 60s, but they're locking in their insurability. And the best part is that when you're young and you're healthy, you're very attractive to an insurance carrier and you're going to get their best rates. They want you as a client.
Yeah, I mean, full disclosure, I purchased a long-term care policy for myself a few years ago, knowing I'm a single dad and my son is not going to be able to take care of me, and I really don't want to bleed through my assets to do that. So I got a policy when I was in my late 30s. So I think that was a very, very wise move. That's a very, very wise move. Well, thank you for your time, Michael. It was great chatting with you. I'm sure we'll have you back on other topics. And to the audience,
Fantastic.
have a great day.
Thank you, Eric.